Okay, welcome here. Today is Saturday, the 26th day of April 2025, and as always, I always come on here on every weekend to very much analyze, not just analyze the market, but also review my previous analysis. Like over the weeks, I've been analyzing gold. I've analyzed USDJPY, USDCHF, where I saw USDJPY on a bearish trend. I started calling it bearish since February. Likewise, USDCHF, while gold on bullish trend. And for last week and week before, these pairs have made their moves based on the analysis, just like USDJPY and USDCHF has been trading bearish. However, merely looking at the trend from my analysis, I see that the market has made a kind of retracement to the upside, a kind of massive pullback. Like USDCHF is now trading very much closer to that support that was broken. And I said, when I see two daily candle close above that support, this is where I will change my bias to bullish bias. However, I still have a bearish bias. Now that it has reached my entry point, that point I want to see it flag and break a kind of trend line that is very much below by taking out the uptrend. This is where I want to start selling to the downside. Likewise, USDJPY, based on analyst and forecast from UBS, the pair it's likely going to make some pullbacks and retracements to the 145 price level. When it gets there, this is where you tend to see another bearish movement. This is where you see sellers start coming in, and this is how trends work. I'm explaining based on provisions of the daily time frame and the weekly and the monthly, because this is where you want to see the overall trend of the market. And trends don't go straight the way we think. It doesn't go, if it's going up, it doesn't just go up. Likewise, if it is selling, it doesn't just sell, it makes some retracements along the way. It goes up, retrace down, up until it gets to the particular level where it's going to, which is likely a major resistance or a minor resistance. Likewise, if the pair is making a bearish trend or a downtrend, it goes like a wave. It makes a wave-like formation. It doesn't just go spike like ruler. It goes down, up until it gets there. This is because of this, most traders don't understand what it means to understand the market, especially if the trader is more technically inclined. Unlike me, I use both the fundamental and the technical analysis because I understand. I want to know the drivers of the market. There is something that moves the market from point A to point B. Likewise, from point D to point E, there is something, there is a news, there is a fundamental event. Just like last week and prior, the fundamental catalysts that have been moving USD based pairs and quote currencies is the reciprocal tariff floors between Trump, the president of the United States, and Canada, China, and other countries. And because of this, over some years, for some weeks and some days, there tend to be a kind of sleep in the market, where the market has been on a range, especially if you are trading USDJPY and USDCHF. You see that the market has been on a range for some time, and whenever it breaks out of that range, it makes a massive pump to the downside or the upside, depending if you are trading the quote currencies, just like GBP USD. If it breaks out of a range, it makes a bullish move, a very strong bullish move. But on the other hand, if you are trading base currencies like USDJPY and USDCHF, whenever it gets to that range, as it's crashing, it's making up to, let's say, 200 pips at once. The movement is going to be very fast because of the way the Trump administration is taking the tariff and everything against other countries. That aside, understanding these things will give you the edge to know where to position yourself, and it saves you from trading out of context. When you understand movement, when you understand price movements, where is this price coming from and where is it likely going, this thing saves you from trading out of context. And most times I tell people, you have to know where you have to know where you're going out of the market before you actually enter. You have to know where your exit point should be before you actually click the buy button or the sell button. And these things you know by understanding how to analyze the market from the higher time frame. That's why you call it the multiple time frame analysis. You understanding from the general flow of the market, which is the monthly. You look at the monthly time frame, the monthly candles. You go to the weekly, where you see the obvious turning points, which is your support and resistance levels. Then you go to the daily time frame. Daily time frame likely shows you chart patterns. If you don't see chart patterns on the daily, zoom out on the weekly. You're likely going to see a kind of double top, double bottom, or inverse head and shoulder. And the other time frame I use to, maybe let's say I want to catch a reversal, is the 4 hour. I don't trade anything lower than the 4 hour time frame. The 4 hour time frame tells you, okay, this is time for the market to start buying, or it's time for the market to turn to the downside. And over the years, it has helped me. I don't normally trade every day. I'm a swing trader. I'm into swing trading. I don't trade every day. I trade when it is necessary, because I know that it takes time for the trend to move based on the time frame I'm focusing on. And because of this, it has saved me from taking impulsive trade over the years. And this is the reason and the ability where this is why I get the edge to hold trades as long as 2 weeks, because now I have the ability to know where the market is coming from and where it's going. If I check my analysis, I check my key levels, and it has not meet my entry criteria, I don't enter the market. Most times, if you tell retail traders this, they feel it's a waste of time. But the best thing that can happen to you in trading is you're coming into trading because you want to grow your capital. You don't want to lose money. Instead of you not to make money, it's better you don't lose money. The worst that can happen to you is when you're managing accounts for people and you are losing them money. The core principle of every business is simply not to lose money. It's best you don't make money than you losing money. And understanding how to analyze the market from the higher time frame, from the higher perspectives, gives you that leverage to know that, okay, is it a time for me to buy, or is it a time for me to sell? Sometimes you look back, you zoom out, leave the 5-minute chart, leave the 30-minute chart, leave the 1 hour chart, and focus on the larger time frames where you see the overall flow of the market. And because of this, I've created a course that very much interprets everything that's needed, that is required for newbies to not just know when to enter the market, but to build more on psychology, more on patience, knowing the right time to take that leap of faith, knowing the right time to enter that trend, knowing the right time to exit the trend. This course is created to save you time, to save you screen time, because you don't want to always be in front of your screen. Because the moment you're always spending time in front of your screen, more screen time doesn't guarantee more profit. In fact, it's on the other way around. It guarantees you that you're likely going to blow up. It guarantees you that you're likely going to lose your money. It guarantees that you're likely going to make mistakes and see trends that are not there. So you want something that helps you cut down your screen time. The more you cut down your screen time, the more profitability comes your way. This is how it is, because the more you keep chasing something, the more it runs away from you. Trading is all about mastery. You want to master the market. You want to master yourself too. And you want to master psychology, knowing, oh, it is not time for me to trade. Because the best courses out there are not the courses that teaches you how to trade. They are the courses that teaches you what not to do. And this is what my course is here to tell you. It teaches you what not to do. And if you want to get the course, you can drop your comments. I'm going to get to you. And before I go to the screen where I'm going to be sharing my screen, I want you to sit back and watch my analysis. I'm going to very much reanalyze and not really analyze, just make an overview of my previous analysis and where I'm potentially likely going to enter the market, where I see a potential reversal or buy position, sell position. So I'll see you on the inside. Let's get to my screen now. Bye. Alright, so welcome inside my screen. Here what I have to do is just to reevaluate my analysis on this space. That was 2 weeks prior, and my trades based on my trade calls last week. I'll start with USDCHF. Let me go with USDCHF and see what I have said since 2 weeks now. I'll have to go to the weekly where I'm going to See, so here is, I mapped out this level. This was a strong resistance that was broken, and this is a support. This is resistance, and this is a support that was broken. And every time, this is a trend reversal pattern. This is a weekly time frame, a very big time frame. And each time the market gets here, as you can see from the left, you can only know what is going to happen by looking left. What's going to happen on Monday, you don't know. You can only predict by looking left. So merely looking at this, how I started calling this pair bearish from here, that was since February. Since February, I started shorting this pair. My first entry was this was my second entry, and now waiting for the third entry to fulfill for me to start shorting, or maybe else it starts trading above this support that was broken before. And look at what happened at the left when it gets here. The first time, when it got here the first time, it broke this neckline. This was a neckline that was sticking out, tested it and tanked to the downside. Likewise, the second time when it got here, broke below this neckline, made a retest, tank. The third time, and what breaks a particular level is always the third touch of that level. If it's a trend line, if it's be it a trend line, be it a level, be it a support level or resistance, the third touch or the fourth tend to break it. And this is the third head, and this is the third touch of it on the downside. And what happened was, whenever a level is broken, you don't start trading off from that broken level immediately. You have to wait for some time for that level to be retested. Then this is where you can now start trading with a free mind. This is how I trade. Whenever I see a level taken out, I don't jump on that level, because my intent on trading that position is long term. So I want to open a position whereby once I enter, I don't want to look back, or I don't want to always be confused when I see the market making some reversals or some pullbacks. That's why I didn't trade this breakout. On the daily time frame, when I saw this breakout, I made this level. This was since first week of April, when I said I'm looking for a retracement to this support level. This is where I want to start selling. I want to see a retracement. I had two entry criteria. First is, if I should see a daily candle close below this line, below this price, O spots 8461. If I should see just daily candle close below this price, then I'll know that okay, the pair is crashing massively. However, I also said if I see a pullback towards this level, and the daily candle close after testing and retest, and I see a daily candle close below this price, this is 0.82894 price here. This is where I want to start selling, which is by next week. I want to see a daily candle close below here, then telling me that it has made its retest and it's now time for it to start knifing down. On the other hand too, I have also a bullish bias, but my bullish bias will be when I see a daily candle close above this strong support that was broken. Remember, this was a broken support, so I don't want to start trading immediately. I don't want to start buying from here, because I know if I enter this position, I want to hold it for as long as 2 weeks. So this is how I trade. I don't trade in such a way whereby I'm always monitoring my chart. I want to be free to do other things. So I want to make sure the trend is okay for me to enter. The market is telling me, okay, it's time for you to go in. It's time for you to go hard and size in. So this is it. Now the market has shown me these retracements. As you can see, if I should go to the daily, to the 4-hour chart, this is it on the 4-hour chart. Now I'm on the 4-hour time frame, and I have a trend line. This trend line is a very minor trend line, which is pointing me towards my entry. Now I want to see the market get here for me to buy. If I want to buy, I want to see the market get here and make retest above this level. Once I see a daily candle close above this level, this is where I will change my bias from bearish to bullish. But since the price is here, I have not yet changed my bias yet, and I still have a bearish bias. This is where I want to start going bearish. I want to see now the market has made a leg. I want to see a retest. I want to see a daily candle close above this price. this is where I want to start selling. Now that it has made this is where I want to start selling. I want to start selling from here. The overall target will be here. This is where I want to break even. My stop loss above here. So I have two entry criteria on this pair alone. So merely looking at this, I'm not in a hurry to enter the market. I'm not in a hurry because I feel maybe the trend is not running. The trend is always here, 247. It has been open since the early 90s, so it's not going to close anytime soon. It is here to stay. So all I have to do is to position myself and be patient enough to wait for the trend to come to my entry criteria, because over the years, merely trading like this has given me the level of profitability. This is why I don't always lose money, because imagine 2 weeks I've not touched the market. So those 2 weeks I'm not losing. So if I should trade, definitely I'm making a short bet, whereby I'm trading a very nice tradable opportunity. I don't just trade because of I want to trade. I trade now because I've seen the market has come to me and have told me that okay, it's time to size in, it's time to go long or go short on this pair, because it has fulfilled my entry criteria. As you can see, the pair was making this low and it got here. This was a turning point of the market. So the next time I want to enter this market, I'll start entering from here, and when it gets here, I will move my stop loss from here to here, in case if the market decides to turn from this turning point again. So now, even if I get stopped out here, I'll have something to take from here to here. But the overall trend, the overall bias, my overall TP is very much long, which is here. And once it crosses here, this is where I will look for another entry opportunity. This is how I start trading with 0.50 lots. Along the line, I add 1 lot. This is how I accumulate trades depending on how long I want to hold that trade. So this is it on USDCHF. If you want to see how I analyze it, you can watch my previous analysis where I started analyzing these pairs. You very know how I go about mapping and marking these levels on the higher time frames. Now on the lower time frame is easy. Likewise, USDJPY. This is it. I will have to go back to the weekly, how I started. Now look at it. This was where the pair started knifing all the way down, and this is the support. However, it got to this support and now it has made a bounce to the upside. But again, I won't still start buying this pair until I see price breaking this low. Now it's making lower high, lower low, lower high, lower low, lower high, lower low, lower high. It wanted to make a new high. However, it made a double top here, an equal high, which is also a sign of a reversal, a bearish reversal, and it's crashed to the downside. Now it's about to make a new low, a new high, sorry, to continue its lower low movement, which means the lower low movement is likely coming to touch or break this level. This is what I mean on the daily time frame. On the daily time frame, this is it. Lower high, lower low, lower high, lower low, equal high, which is a bearish reversal. The neckline broke it. Lower high, lower low, lower high. It has made a lower high. It's now time to make a lower low. So my bias is still very much bearish. I will start selling once I see a 4-hour candle close below this price. I don't like trading on catching the trend. I want to see it trading below here. This is where I want to start entering. Now someone might ask, since the market is going like this, what if the trend turns to be bullish? I will only start going bullish if I see a daily candle close above this level. You see this price, and my bullish bias is not going to be longer. My bullish bias will be the next turning point, which is here, where I'm going to close here, because when the market gets here, it might likely make the same thing it did here by creating an equal high to the downside. So whichever way I want to trade, my downside is protected. Now for me to go bearish, I want to see a 4-hour candle close below here, and for me to go bullish, I also want to see a daily. Now this is a daily candle close above this level. Once I see a daily candle close above this level, I enter. Look at my RRR 2.81, TP, stop loss, easy. I've created a course around this that teaches how I go about mapping this level, how to know when the market is trending up, down, and sideways, how to spot out key levels, how to spot out reversal patterns. Like this is a double top. After the break of the neckline, it started knifing down. Likewise, this is what I see likely going to happen here. Now the pair might move from here to here, create this same scenario, and start knifing all the way down. So whichever way, if I get here, if I'm going bullish, I want to stop here, and if I want to start my bearish movement again, once the pair failed to make a new high above here, thereby countering all this trend, if it starts trading all the way down, this is where you're likely going to see a new entry position from here, which is this from here. After breaking below here, this is where you want to enter to sell from here now to here. So you can see I have different entry criteria on the same time frame. I have different criteria to wait for. Once these criteria are met, this is where I tend to start going bearish or bullish. I'm not in a hurry to trade because I know I have a strategy that very much tells me when to enter the market and when not to. If I'm able to know this, if I'm able to gather my bias, have my technicals in shape, now is to go to my fundamental. My fundamental tells me these joints are all entry criteria. It doesn't mean I will enter following the technical alone. I also use the fundamental. I take analysis from analysts from UBS, from Goldman Sachs. Most of these analysts, even from banks, most of them call based on what they see. These analysts from these banks, they do bring out their own forecast, and most of the time my technical and what I feel the market will do come in confluence with what these analysts are saying. That's why I don't trade every day. I want to make sure I trade when the odds is on my side. This is what you call it a trading edge. You trade only when you have the odd on your side, because it's a 50-50 game. It's just like playing chess. You only win when you have the odds on your side. So this is it on it. On the other pairs, I have GBP USD double bias. Likewise, bullish ones I see a daily candle close above here to this side, because based on analysis from UBS, this is their next resistance. Likewise, support. If the pair starts to tank, this is where the next support is coming. So I want to catch this reversal from here to here. It's as easy as that. Likewise, as you can see, Euro USD. From here, I want to start buying from here to the upside. Gold, I have all these markings. I kept them since last week. Now gold has flagged. I'm waiting for another buy opportunity. Now if I should bring my Fibonacci from swing low to swing high, this is the 0.50 fib level, and if the market gets here, all it could do maybe to rumble around until it gets to this trend line. But however, if it doesn't get to this trend line, this is another entry position to the upside, and we all know gold like to fulfill round numbers. The next level is, now it has touched this 3.5, made a bearish reversal. The next level is 4K price, and easy. If you're able to understand price movements, how price move from one point A to point B, point C to D, it tells you what not to do in the market. Most people think having a strategy only guarantees you success. This strategy also guarantees you what not to do. It tells you what not to do, how not to trade impulsively, how not to take dumb trades. You want to make sure you're trading when the odd is on your side. That's why I've created a course around it, teaching how I go about knowing this level. Inside the course, I also have a session that I discussed more on fundamental, how to know what moves the market, where to get your fundamental news from, and how to pick the news that are very much important you should look out for, especially if you see news from People's Bank of China, or you see news from ECB, which is European Central Bank. You see news from BOA, which is American Bank of America. All this news, all these their analysts, the things they say, the numbers, and where they see price going is where you want to be looking at. Of all these lines, all these joiners, I didn't just draw them from my head. I took some from analysis from these banks, from Goldman Sachs, JP Morgan, and what these generally these are their general forecast over time, and they don't trade every day. These guys trade on swing positions. They like to hold trades, and along the way they add to their position. So you very much want to be trading like them if you want to be on a safer side. You're not a commercial trader whereby you have the liquidity to turn the market. You are still a non-commercial trader. So all you have to do to be on a safer side is to do what? Trade like them. So this is it on this session of the channel. I'll see you next week, where I want to be reviewing my analysis. All I have to do is just to review, because I've already analyzed the market prior. Else, maybe if I see the market changing in trend, this is where I want to reanalyze the market. So I'll see you on the inside now. Let's go back to where we started. All right, thank you. I want to thank you for sticking through the end of this analysis. As you see, how I analyze the market following the trend from the higher time frame, which is the weekly and the monthly, and I scale down to the daily time frame. I also scale down to the 4-hour, explaining why I want to take a particular position. Like on USDJPY and USDCHF, I have double bias on them because the market has gotten to a resistance level, a support, sorry, and it has made a test. Like on USDCHF, is now testing closer to that support level. I can only change my bias if the resistance, which was a previous support, is broken and has turned to a new support. This is where you want to start buying. Likewise, USDJPY, when it breaks that level, the next level will be the next top, whereby it wants to form a double top formation. And when you learn how to trade like this, the strategy doesn't just give you the ability to trade, it gives you the ability and tells you what not to do. And this is what most traders find difficult to understand. Sometimes being patient enough doesn't mean you are not seeing trades. Being patient enough is saving you from your downside. It's saving you from your own impulse, saving you from your impatience, saving you from blowing and losing people's money. Now, most traders always, especially when you trade every day, more screen time doesn't guarantee you profitability. This is what newbies understand. They think is, yes, at the start of your career, you have to at least invest 1,000 hours of screen time, which is just a year. 1,000 hours, you have to be staring at the screen. This is how you catch up trends. This is how you understand patterns. But over time, you get to understand that more screen time doesn't guarantee profitability. In fact, it's on the other way around. It makes you blow up and lose money, because now the moment you're stuck in, especially if you're trading the lower time frames like the 5-minute chart, the moment you're stuck there, this is where algorithms are now joking with your senses. You start seeing double top, double bottom, and any chart pattern, no chart pattern holds on lower time frames. You can only see chart patterns on the daily time frame and the 4-hour charts. Whenever you see chart patterns on these time frames, even candlestick patterns, these patterns tends to hold on those bigger time frames. If I see a bearish pin bar or bullish engulfing or bearish engulfing on a weekly chart or the daily chart, I take it seriously, very serious. But if I see it on a 4-hour chart, I just sit back and analyze and try to use my brain. I go and check my fundamentals to see if there is likely a turning point from there. I look at what the banks are saying. I look at maybe if Trump wants to say something, or if he's saying something about a particular economy. I look at the European Union, the European Central Bank. I look at the Bank of America, what they are saying. When I see all these chart patterns and pin bars on the 4-hour chart, I don't really take them serious until I have claims to back it up. But once I see them on a daily or on a weekly chart, you have to take them serious, because most of the time that tends to be a turning point of the market. It's just like seeing a double top or an inverse head and shoulder on a weekly chart. Bro, you have to take it very serious. But if you see all this thing on the 5-minute charts, no, nobody takes those serious. On the 5-minute chart is where algorithms are in play. These are where algos are looking for stop loss to hunt. Because now, if you are using a stop loss on a 5-minute chart, definitely your stop loss is a tight stop loss comparing to my stop loss. Most times I use a 100 pips stop loss, especially if I'm targeting 500 pips or 1,500 pips ahead. I use a 100 pips stop loss. I think the lowest stop loss I've used is 36, maybe 37 thereabouts. That depending on how long. So if I want to hold a trade for 2 weeks, don't expect me to use 20 pips stop loss. No, I use a higher stop loss because I know where my target is, and along the line I add positions to that. So this is how to go about trading. When you understand that it's a career, it's a skill, and it's a skill that requires more patience. It's not a get rich quick scheme. You can't just come here. Nothing is quick as you think. Just like you watch people on X posting blues and everything, it's not really easy. Those guys suffered before they get to that extent. Just like my mentor, he suffered before he became who he is today. So all these guys have paid their dues. So it's easier for them to spot trends. It's easier for them to use 50k and target just 20 pips because they have the capital, one, and they have the experience over the years. Now imagine someone that started scalping from their first day of trading and they've done that for complete 10 years. The experience and yours won't be the same. They know that, and you going to them, let's say for signals, it's not profitable over time. So if you want to understand how trading works, you need a strategy that guarantees you success, or a strategy that guarantees you and saves you from that screen time. Comment trading edge on the comment section and I'll get to you, and I'll see you on the inside. Cheers.